Are you looking to up your trading game? Look no further than the Relative Strength Index, or RSI, indicator. With 820 years of backtested data, it's clear that using RSI as a trading tool on OHLC charts is generally a profitable strategy.
RSI measures the strength and speed of a market's price movement, creating an oscillator that ranges from 0 to 100. Readings above 70 indicate an overbought market, while readings below 30 indicate an oversold market. To utilize RSI for trading, traders typically look for buy and sell signals based on the value of the RSI oscillator. When the RSI exceeds 70, it indicates an overbought market, meaning price increases may slow down and reverse.
As such, traders typically sell an asset when the RSI line crosses down through the 70 mark. On the other hand, when the RSI is below 30, it indicates an oversold market, meaning that price decreases may slow down and reverse. Traders will typically buy assets when the RSI line crosses up through the 30 mark. While RSI is a powerful trading tool, it should not be used in isolation. It is best combined with additional chart patterns and indicators to avoid false signals and losses due to market consolidation phases. Additionally, stock volume should always confirm the validity of any buy or sell signals.
Overall, using RSI as a trading indicator is a winning strategy. It beat the S&P 500 over 26 years by 45%, and produced 53% winning trades on the Dow Jones Industrial Stocks. To improve your chances of trading profitability, use this indicator on hourly charts using the RSI 14 setting. It's time to elevate your trading game and start mastering the RSI.
Free and pro investing courses, strategies and original research at LiberatedStockTrader.com.